Okay, welcome back, guys. Today we'll be basically talking about how to use the Fibonacci retracement tool. That's one of the one of the best tool on the TradingView platform. So basically, all we've got is the 100% retracement, 70.5%, it's 1.86%, 38.2, and the 0% retracement. So basically, what we're looking for is retracement. We don't know whenever the market is trending to the upside or to the downside, we don't know when the price is going to retrace or where it's going to retrace. It's not always perfect like this. You don't always know when the price will retrace. You don't know when the price will retrace back or wherever it will get to. So sometimes some support and resistance traders use the previous resistance zone. So they use some of them use the previous resistance zone that price might come back to this zone so that they will to long, a uptrending market. But we don't know. So in this video, we're going to learn how to use the retracement tool. So let's say market is trending to the upside, like this. We have a retracement, a continuation, and price is coming down. This is where your Fib tool comes in. You tap on your Fib tool, take from the lowest price to the highest. That place that price stopped. I mean the highest place that price stopped. Wherever you see a halt in price, wherever you see a stop in price, that's kind of a high. It's even a high. So the highest place that price stopped. And so what we're looking for now is the retracement of this. So basically what we're looking for is the hold on guys. So what we're looking basically is for the retracement of this particular uptrend. So we don't know when, or we don't even know where to, stop. So what I have to do is wait for this retracement to come back to either one of these levels. So whenever price comes to 70.50 or 70.5, that's a steep movement. And it means that the momentum is too much. So the basic one that everybody likes and uses, even including me, I like using this 1.8, the 50% retracement. 50% is half of the retracement. So if price comes back to 50% and gives us a reason to buy, so this retracement now means a discount. You can't buy at a high price. The reason why we're waiting for retracement is because the price is too high and we want it to come down. So you get a cheaper price. For instance, now let's say we want to get this price at 21.25. This is we'll wait for it. We'll have to wait for it to come down. Because why? The reason why we are waiting for it to come down is because the 21.33 is high. This price is too high. And most traders, most newbies might come to this market and see that this market is trending up. And some of them would like to long this market, take it to the end. They like to long it even as the price is too high. Some would like to long from here. But if you've gotten some experiences, you should know that this price is too high. And whenever it's high like this, you don't sell or you don't do anything. What you have to do is wait for a retracement or a discount, back to one of the Fib retracement. Sometimes price doesn't respect this Fib. Just good. Sometimes price itself can even get to the 0.0 level. Sometimes price can get there and move up from there. So price can do whatever it wants. What you have to do is trade with the trend or trade with the price, whatever the price is. So as I was saying, we like to use this to 1.8, 50% retracement or 38.2. But personally, I like using this to 1.8 and 50% retracement. I don't like using 70 and 38 based on personal reasons. So that's just basically how to use it. So if our price gets to, let's say for instance, price gets to 50% retracement, you can wait for some reasons to get into a trade. Whenever you see those reasons, that's when you long. Sometimes you take your profit at the nearest resistance or support and resistance zone. That's how you do it, and your stop loss there. And this is a very nice trade. So let's go on the chart and let me show you basically, how to use it on the chart. Please note that I am not a financial advisor. I'm just here to, share some basic knowledge of trading. So let's go. This is gold on a daily time frame. So let's want to, want to wait for because this price, as I was saying before, whenever you see a high price, you don't want to jump in, you don't want to do anything. What you have to do is you do what you wait for the retracement of that price because you see that this price is too expensive and you can't afford to buy at this zone here. What you can do is wait for a retracement or a slight pullback so that you can join a trend. That is the main reason for that's the main reason uh for Fibonacci retracement. We have to use it to make money. We don't care about the definition or whatever. You just learn to use how to use Fibonacci to make some money. So now take from the lowest price to the highest. So here is the highest. As you can see, here is the highest of the prices. Here is the highest. Why? Because this is place that price got to and rejected. As you can see, price got to this place and rejected. So this is the place when I was telling you, I was trying to explain. So you have, sorry guys, so let's say you have an uptrending market, as I told you before, uptrending, and you're waiting for the retracement because you don't know where this price might retrace to. We're waiting for the retracement of this particular trend. So you have to wait for retracement to one of the levels. That's where you can take decision to buy or to sell. So for this instance, we are buying. So we look for price to get to 61.8 retracement zone. This is the zone, guys. This is the zone. As you can see, previous resistance turns to support at the 61.8. So you can look for other evidences or other points, other proofs to show that this market is really, you're ready to go in. You can even go down to the 4 hour or the 1 hour time frame before you can buy. So let's say, for instance, we took this market here, and we took it from this zone here to the next support and resistance, and our stop loss is here, or you can use the stop loss below this level. So something like that. So basically, that's just how to use Fibonacci. Let's look for the downtrending market. Okay, this is a perfect one. So as I was saying before, let's just make it the reverse. A downtrend, price pulls back to continue the downtrend. Don't forget, what is the market structure? Market structure is basically, price pulling down gives us a low and a lower high. Whenever price breaks this lower low, this is where we can say we are in a downtrend because price can basically, price can break this high here. So whenever we call it a downtrend is when price breaks this lower low and gives us a low here and comes back. So that's basically the downtrend. So what we're looking for in a downtrend is basically a low. Whenever price is high, because price is too expensive, you can't sell from there. You can't sell from here. You have to wait for price to give us a cheaper rate at a cheaper amount. That's when you can sell these assets or markets. So whenever price gets to one of the retracement rate levels or back to 61.8, 50%